Welcome everybody, thanks for joining the webinar today. My name is Chris Ashton, I am the head mentor at the Corellian Academy. I was a trader for 20 years, first at UBS and then Barclays, and since leaving I focus solely on delivering content on what's happening in financial markets. Now, I have been following cryptocurrencies, in particular Bitcoin, since 2019, just before its first meteoric rise from $3,000 to $68,000, fall back to $15,000 again, and then rise to the current price levels we see today, which does highlight the potential for extreme volatility in these cryptocurrency markets. Today, to help you increase your knowledge of more of the CFDs that are available to trade on the Plus500 platform, I'm going to discuss the basic things you should know about cryptocurrencies. More specifically, I will delve in further detail into Bitcoin, the most well-known cryptocurrency in the world, then move on to focus on Ethereum and showcase the 20 cryptocurrency CFDs available to trade on the platform, before finishing up by highlighting some of the other options available on the Plus500 platform for trading instruments with crypto market exposure. Okay, let's move on. So what are cryptocurrencies? Simply put, they are digital or virtual currencies that use cryptography for security and operate on decentralized networks based on blockchain technology. Blockchain technology is a decentralized ledger system that records transactions across multiple computers or nodes, where each computer has an entire copy of all of the transactions, ensuring no single entity has complete control of the data. Cryptocurrencies serve as a medium of exchange for goods, services, or money directly between individuals or businesses, in a similar way to how traditional currency, such as euros, sterling, or dollars, for example, can be used. The difference from this traditional currency is that cryptocurrencies enable these peer-to-peer transactions without the need for banks, financial institutions, or other centralized authorities. Okay, so in terms of trading, how do cryptocurrencies differ from traditional assets like stock indices, individual stocks, or FX pairs? Some of the main differences include trading hours. These cryptocurrency markets are open 24 hours a day, 7 days a week, which means when you're trading these products, you must be prepared to experience unexplained moves, especially on weekends, for example, when traditional markets are closed. Risk management is critical to protect your trading capital, and to help you with this, I would suggest you consider using the stop loss and take profit order functionality on the Plus500 system. A stop loss is an order I can enter in advance on the Plus500 platform to close my position at a defined price level I have planned for, which limits my loss in the event of an unfavorable move, while a take profit order is a different type of order I can enter in advance to close my position at a defined price level I have planned for to profit from a favorable move in the instrument I'm trading. Cryptocurrencies tend to be more volatile. This is because these markets are relatively new and less mature compared to traditional markets, leading to smaller trading volumes and limited liquidity, which can amplify the price moves. Next is market size. As of March the 25th, the total cryptocurrency market capitalization sits at around $2.6 trillion, which is small when compared to global stock indices. For example, where the S&P 500 index is valued at $44 trillion, and Microsoft, the biggest company on the planet, has a total market cap of around $3.2 trillion on its own. If I drill down a little deeper and look at the market capitalization of the top 10 cryptocurrencies, you can see the market is dominated by Bitcoin and Ethereum, who have been the standout number 1 and 2 in this table since I started following them in 2019. As you can see, Bitcoin at 1.3 trillion has 3 times the market cap of Ethereum in second place, which in turn at 414 billion is over 4 times larger than the number 3 coin, Binance Coin or BNB, at 87 billion. This chart shows the dominance of these 2 main cryptocurrencies, and what you often find is what is good or bad for these specific coins will impact sentiment for the wider market. That doesn't mean that the cryptocurrencies below Bitcoin and Ethereum on this table don't have their own drivers and move independently. They do. But the coins between 3 and 10 on the table will regularly switch positions. Only last week, a surge of 35% in 7 days for Dogecoin sent it spiking above Cardano into 6th place. Okay, so let's look at some of the main drivers of price moves for these cryptocurrencies. These can broadly be grouped into 4 general categories. The first is market sentiment. This plays a significant role in cryptocurrency price movements. Positive news, such as regulatory clarity or institutional adoption, can boost sentiment and help to drive prices higher, which is something traders have experienced throughout 2024 so far, with the SEC approval of the spot Bitcoin ETFs in January. While negative news, whether it may be security breaches, crypto exchange failures, like when FTX failed back in November 2022, or regulatory crackdowns, can hurt sentiment and lead to price declines. I'll touch on the SEC approval of the ETFs from January later in this webinar. Supply and demand dynamics can also influence sentiment in the crypto market. These are usually due to factors impacting the circulating supply of a particular cryptocurrency, which determines its market capitalization. For example, a coin burn is a deflationary mechanism that is used to permanently remove coins from circulation. Here, a predetermined number of coins are sent to a one-way wallet, ensuring they cannot be used again in the future. This reduction in supply can help increase the price of a particular cryptocurrency, like a share buyback for individual company shares. The opposite of this is known as an increased coin issuance, which is the creation and distribution of new cryptocurrency into circulation. This increases the supply of a coin and can potentially drive the price lower. Just remember, these events are often scheduled, so the market may move in a certain direction and in anticipation of an event, and then reverse as traders look to exit positions. The next category is adoption and acceptance. Increased adoption can positively impact prices. Factors such as the integration of cryptocurrencies into payment systems, the development of infrastructure such as wallets or exchanges, and the expansion of use cases, for instance, decentralized finance or DeFi, alongside technological developments like advances in blockchain technology, scalability solutions or system upgrades can impact prices positively, while delays to these upgrades or high-profile adoption tries and fails, as well as security breaches, can impact prices negatively. The regulatory environment is category 3. Regulatory developments and government policies regarding cryptocurrencies have a significant impact on market prices. Clarity and favorable regulations can boost investor confidence and encourage institutional participation, pushing prices higher, while uncertainty or restrictive regulations can lead to market volatility and hinder adoption, negatively impacting prices. The final category is macroeconomic events. Just like equity markets, FX, and commodity markets, cryptocurrency prices can be influenced by macroeconomic events and broader economic factors such as inflation, the level of a country's interest rates, geopolitical events, and the release of economic indicators. For example, economic uncertainty or fears of a systemic risk event may drive demand for cryptocurrencies as a hedge against traditional assets, while changes in interest rates can have a positive or negative impact on prices, depending how it impacts general risk sentiment and alters traders' expectations. Now that's the basic categories. I should say there are more detailed considerations that traders and investors use to analyze and predict movements in cryptocurrency CFDs, but that is a deeper discussion for a different webinar. What this does mean is that trader behavior can be unpredictable and subject to rapid changes, highlighting that even the best planned trades can at times be negatively impacted by something out of nowhere. So that's the backdrop. Let's focus a little more on the number one cryptocurrency, which is Bitcoin. So what is Bitcoin? As I said earlier, Bitcoin is the most well-known cryptocurrency, created in 2019 by an individual or group of individuals under the pseudonym Satoshi Nakamoto. It can be accessed and traded globally, enabling cross-border transactions with relatively low fees and fast settlement times compared to traditional financial systems, with users sending Bitcoins to each other using digital wallets. These transactions are validated and processed by miners who compete to solve complex mathematical puzzles using vast amounts of computing power to ensure the sender has the Bitcoin that they're trying to spend. The first miner solving the puzzle is rewarded with newly minted Bitcoins, and that's important for us today as some of these miners, such as Marathon Digital Holdings, are also CFDs tradable on the Plus500 platform. Now, some of you may have heard Bitcoin described as digital gold. This is because it has a maximum supply of 21 million coins, of which 19.6 million are currently in circulation. The remaining coins are issued at predictable, predefined rates until the maximum supply is reached. The last Bitcoin is not expected to be mined until the year 2140 due to halving events, which I will outline in more detail in a moment. It's this limited supply or scarcity that has led to suggestions it could potentially be a store of value, a digital version of gold, and a potential hedge against inflation. Now, however, that theory is yet to be proved one way or another, given that its price is highly volatile, which can make it a risky investment when compared to more traditional assets like gold or government bonds. But certainly in the last month, gold and Bitcoin have, for brief periods, traded in tandem, but there is no guarantee that this continues. So the price of Bitcoin has risen nearly 155% since its October 2023 lows at 26,735. Three main things have helped this on its way. The first has been an improved risk appetite across all markets. It's no surprise that the move from around 27,000 in October to above 38,000 in dollars in December all happened at a time stock indices were also racing higher, supported by the Fed's dovish pivot at their last rate meeting of 2023, a move which has continued during the first 3 months of 2024. More specifically, in November and December 2023, traders started to buy Bitcoin in anticipation of the approval by the Securities and Exchange Commission, the SEC, the US stock market regulator, of the first series of spot Bitcoin exchange traded funds, or ETFs. This helped to take prices up above $38,000 in early December. The SEC approval was officially given on January 10th, 2024, which took prices to a new level above 48,000 and established a trading range between $38,000 and $48,000 until the middle of February, when we saw the first and most significant breakout to the top side, when $48,000 broke and the new all-time high was registered at 73,697 on March the 14th. Now, this SEC approval was significant as it was the first time US regulators had approved ETFs that directly invest in Bitcoin, broadening access for a wider range of retail and institutional investors, especially given that the huge global funds like Fidelity and BlackRock have now become involved in the crypto markets. Since the approval on January the 10th, the net inflows into these ETFs were recorded at around $10 billion, which goes a large way to explaining the recent push to those new highs. However, since then, small net outflows have been recorded in the last 2 weeks, coinciding with a fall in Bitcoin prices. Overall, the net inflows into these ETFs reflect the level of investor excitement generated in the last 6 months, but also highlights the new challenge going forward for traders. Will this buying interest be maintained and the ETF inflows increase again, or will they start to die off? Much will depend on Bitcoin prices finding a base to recover from on this dip from the highs, and how quickly any up move can be re-established and a new high registers. This brings us nicely to looking forward. One key event due at some stage in April is the Bitcoin halving. This is an event where the reward for mining Bitcoin is cut in half. Remember, miners are the ones who solve complex mathematical equations to validate transaction and ensure the security of the Bitcoin blockchain. This halving means companies like Marathon Digital Holdings, who I mentioned earlier in the webinar, will receive only 3.15 Bitcoins per successful mining operation, rather than the 6.25 Bitcoin they receive currently. In theory, this reduces the supply of Bitcoin and potentially helps to push up the price if, and if it's a big if, demand remains the same. The specific halving date in April is not known, as it depends on a specific mathematical formula based on how quickly blocks are generated on the blockchain, but it's expected to be between the 19th and 21st of that month. Now, this event happens every 4 years, and after the previous 3 halving events in November 2012, July 2016 and May 2020, Bitcoin prices increased and reached all-time highs. However, I need to add a disclaimer here. That doesn't mean the same will happen this time around. This event has been widely written about and eagerly anticipated by traders, and unlike the other events where prices were recovering from cyclical lows, Bitcoin at this halving event has just hit a new all-time high. So this event may already be factored into the current price. Okay, let's look at some of the other cryptocurrency CFDs available to trade on the Plus500 system. You can see the 20 coins listed for you now. While I don't have the time to discuss each one, I would like to focus on Ethereum, the second largest cryptocurrency in the world. Ethereum goes beyond just being a digital currency like Bitcoin. It was designed as a decentralized software platform, and its flexibility and expansive ecosystem have made it the leading platform for decentralized applications and the foundation for many blockchain-based projects in finance, gaming, and other key emerging sectors within the cryptocurrency space. Ethereum has at times been described as the digital silver to Bitcoin's digital gold. If I briefly lay out some of the differences between the two main cryptocurrencies, Bitcoin was primarily designed to carry out payments, and it has a finite supply, while Ethereum was designed to support much more expansive use cases. Ethereum also has more competitors such as Solana, Cardano, and Avalanche, to name a few, and it currently doesn't have a cap on supply, although there are frequent coin burns which reduce the circulating supply of Ethereum, which currently sits at around 120 million coins. Looking at the prices of Ethereum since 2019, you can see it's followed a similar price action to Bitcoin, rising from $110 in January 2019 to its all-time high at $4,861 in November of 2021, before hitting a low at $879 in June 2022, and then rising to a high of $4,088 just 2 weeks ago. Looking forward, Ethereum has just undergone a major upgrade known as the Denkun on March the 13th. So the hype around this is probably what supported prices to that high on March the 12th. This upgrade was designed to significantly reduce transaction fees and play a crucial role in achieving mass scalability. How this plays out in terms of its price in the longer term remains to be seen. The next major development for Ethereum could be whether the SEC approves the creation of its own spot ETF. Expectations at the start of March were high that BlackRock and Fidelity, amongst others, would be able to get this approved based on the success of the Bitcoin ETFs. But the SEC has recently pushed back on their requests, wanting more detail to allay some of its key concerns. The deadline for applications has been set by the SEC at May the 23rd, but traders will be watching to see if applicants update their filings in April. If they do, traders may see this as a sign of optimism that SEC approval is likely. Either way, the SEC are likely to provide further updates in the coming weeks, so keep an eye on the headlines around this, which could impact Ethereum prices. Okay, so for the final part of this presentation, I just wanted to highlight some of the other options for trading crypto market-related instruments on the Plus500 platform. I've already shown you the cryptocurrency CFDs available, and they are on screen again for you now. And I've also discussed Bitcoin and Ethereum, the top two cryptocurrencies in the rankings. But there are other relevant CFDs available on the Plus500 platform that have exposure to the crypto market. The first is the Crypto 10 Index. This follows and measures the performance of the top 10 cryptocurrencies in the market, and these are on screen for you now. As you can see from the price chart, since October the 14th, 2023, the index has risen from around 7,000 to a high at 20,664, a gain of nearly 200%, but it's since slipped back to 19,000. Now, during this October to March up move, it actually outperformed Bitcoin and Ethereum, which rose 175% and 164% respectively, as it benefited from the outperformance of the other altcoins in the index, notably Solana. The second option are the ETFs I've discussed numerous times during this webinar. The 11 ETFs approved by the SEC on the January the 10th are all available to trade as CFDs and are listed on screen for you now. To find them on your Plus500 platform, go to Trade, scroll down to the bottom of the instrument list on the left-hand side, and if you click on Bitcoin ETFs, they are all listed there for you. Now, the final option I will mention is trading the CFDs of the individual companies with crypto exposure. I have listed some of those, some of the options here. I discussed the Bitcoin miner Marathon Digital Holdings earlier. Coinbase is a cryptocurrency exchange. You can see from the Coinbase price chart since October the 14th, 2023, its share price usually benefits during periods where sentiment towards cryptocurrencies is high as volumes increase, and its price drops during periods of inactivity or where cryptocurrencies are in a downtrend. The next company, MicroStrategy, is an American software company that pursues two main corporate strategies. Number one, to grow its enterprise analytics software business, and number two, to acquire and hold Bitcoin. To this end, its share price is greatly impacted by the directional moves of Bitcoin. As of February 2024, it held 190,000 Bitcoin, purchased at an average price of $31,000. You can see how this impacts its share price in the price chart on screen now. Since October the 12th, 14th, 2023, the move is almost identical to the one in Bitcoin. Although between January the 23rd and March the 15th this year, it gained 313%, while Bitcoin was up just 81% during that period. So timing of trades is important. All of these companies will be influenced by the direction of investor sentiment towards cryptocurrencies. But also, as individual currencies, they are also led by their earnings updates, any regulatory issues they may have, or other technology-related issues. Okay, just before we go, and answer some of the many questions you have, I just wanted to reiterate this webinar isn't investment advice, but it's a tool for you to utilize to become a more informed trader. Let's move on to the questions.